mywealth.com. I'm Mike Conlon. I'm one of the senior instructors with the courses. Welcome to today's blog. Today's blog is entitled September Effect Overblown. Okay, well, historically speaking, the month of September has been the worst month for U.S. stock market performance. All right, this has commonly become known as the September effect. Okay, in the same vein as the sell in May, go away aphorism, the September effect has had an impact on market psychology and can create a negative bias for market participants. All right, now under normal market conditions, and by this I mean without government intervention, all right, the stock market rally that has gone on since March would indicate a strong uptrend in growth, yet there's a greater sense of fear that this trend may be fleeting and that a major reversal may be coming. All right, while it's apparent that the government economic stimulus plans cannot go on forever, is the market really going to sell off that much once these plans are finished? Let's have a look.
As always, be sure to check out the written blog at www.mywealth.com/blog. Alright, so let's take a look here at the chart of the SPY. This is the spider. This is the ETF for the S&P 500 index. If you're unfamiliar with ETFs, you may want to think about taking a look at our ETF course. It really gives you a good overview of how ETFs work and what they mean in relation to other areas of the market. But what this spider is showing you basically what the market's been doing for the last 6 months. And as you can see here, we talk about the market bottom that happened way back in March, and we've had a sustained rally from there. Nice uptrend that goes right up. Looks like we even bounce off this little trend line and keep moving. But as you'll notice from the chart, we also have at the bottom volume, and we're showing decreased volume here. Okay, so as you can see, the levels have gone down quite significantly over time, and what that's telling you is that yes, while the market's been going up and we've had a nice rally, there's been a lot of people who haven't participated in the rally. Okay, so they've sort of missed the boat, so to speak. So that's going to be one of the issues and one of the reasons why the market's going to move ahead as we go forward. So let's take a look at some other reasons here. All right, basically there's three reasons why we think the stock market rally is going to continue. Okay, and the first is called fund manager performance anxiety. Okay, and what that's going to do is that's basically saying that, as I showed you on the chart, a lot of people missed the boat and they haven't been invested. So what they've been doing is they've been waiting for pullbacks. So every time you see a pullback, they buy the pullback to take advantage of the uptrend in the market. All right, but it looks like there hasn't been many areas for pullbacks here, so there hasn't been good opportunities for them to get in at better prices like they would rather do. So what happens when that occurs is, they're worried about the performance of their fund, because now they have to say to themselves, okay, well, if I didn't participate in this rally, what have I done? My investors are going to want to know, that, hey, the market's up, some 30-something% this year. Why haven't I participated in that? And, you can go back and you say, well, the fundamentals weren't that great. There was a lot of uncertainty. And you know what? At the end of the day, your investors don't want to hear that. Okay? Especially if you showed them a negative return in 2008, like many managers did. So if a manager hasn't participated in this rally, all right, he'd better get in now. Because if he didn't and he showed negative returns last year, he doesn't have good returns this year, he's probably toast anyway, meaning people are going to pull their money from his fund, so he might as well just dive in right now, hope to get lucky. It's an unfortunate way to view these things, but that's how some of these guys think. So that's something you want to be aware of, especially if you're going to get involved with investing in different funds as well. But that's just sort of the mentality that a lot of these like hedge fund managers have. All right, the second thing we want to talk about, the second reason why the market is going to continue, is because of the reliability of the financial data. All right, and that's in question. Now, when I say that, what we basically mean is that you hear the data that comes out, and here's the unemployment number, or here's the GDP figures, or something like that. But when you talk about the reliability of these numbers, you have to remember that the government's putting these numbers out, and it has the ability to pick and choose the bright spots, so to speak, so as not to spook the market. So this whole time that we've been going through this recovery process, okay, the government has basically they've wanted to show the best side of these numbers and in the best light. So, while we still show that, we have, negative employment numbers, or, people are still losing jobs, okay, when that rate decreases, all right, that's seen as a good thing. Okay, and that's unfortunate, because that's basically what this market has become. That less bad equals good. Okay, so there's a lot of room for interpretation there. And barring any major catastrophes as numbers goes, the unemployment figures are going to be the big numbers coming up. So, right now we're losing around 250,000 jobs a month, which, I guess that's a good thing. But, if you ask me, we'd probably want to see positive numbers first. But hey, the paradigm in the market has shifted, so you need to be aware of that. But if something like the number should go back up to 500,000 or something like that, if you saw a really bad number, that would be the only thing that could affect this market. But I don't foresee that happening, just because I don't think that the government's going to show you a number like that. Okay, a lot of this recovery is predicated upon the stock market doing well, and whether it's a good thing or a bad thing, for better or for worse, that's how I think it's going to play out. All right, the last thing that's keeping the stock market afloat, and the other reason why I don't think it's going to go down, is because there just isn't anywhere else to put your money where you're even going to get a chance at a decent return. Interest rates now are super low. We've already discussed this, and we actually talk about it in some other blogs. But what are you going to do? You're going to put your money in a savings account or in the bond market? There's no return there, basically. I mean, it's the money's just sitting there idle. You're not making any money on it. So your best chance for making a gain is going to be in the stock market. So those are the reasons why we think that the market is going to continue to move higher in the month of September, and this September effect is a little bit overblown. All right, so don't wait. Get in a course, get educated. Come to www.mywealth.com and find out how these and other factors can affect the markets.
As you can see, sometimes trying to grasp all of the reasons why a market may be moving can be a fool's folly. Right, when factors other than actual economic performance affect the market, sometimes it's just better to jump on board and hope for the best. All right, but be sure to use proven risk management techniques to protect yourself from losses. All right, to learn about how to use these proven risk management techniques, be sure to check out our investing and stock market courses. So I'm Mike Conlon. Thanks for being with me, and I hope to see you in those courses.